Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, February 6th, 2020. Oh, been a pretty crazy week. All of a sudden, the market shoots right back up to all-time highs. We saw it on the NASDAQ. We saw it on the S&P 500 yesterday. Barely, but we did see it in terms of closing price. And the Dow right on the heels of another breakout to an all-time high. So market looking pretty good. We're actually getting some relative strength here over the past couple of days for mid caps and small caps. So we are seeing a lot of, wide participation, which is what we expect to see in secular bull markets. But we got a lot to go over. So why don't we go through the agenda for today, and then we'll get into everything. Going to start off with that daily market recap, take a look at some of the sectors that were leading yesterday. In talking technically, I do want to just quickly go over, I mentioned secular bull market. I'm going to show you what it looks like if you haven't seen it. In earnings spotlight, number of earnings, especially this morning, a lot of companies coming out with big moves one way or the other. Still seeing an overwhelming majority of companies beating on bottom line, but that doesn't always translate into a move to the upside, and that's what makes trading into earnings so difficult. But got a lot of examples for you there. Upgrades, downgrades, and I'll get into scooter movers. I'll show you from your dashboard how you can go from the small cap scooter movers right into an RRG and get a good sense of whether or not a stock is making a move that maybe you can rely on, or maybe if it's just one that maybe is a dead cat bounce. But we'll talk a little bit more about that later. And then we'll wrap up with 3 you must see. These are just 3 charts that I like, that caught my eye, and I want to share them with you. And could be trading opportunities, could just be shifts in the market, whatever. But I'll bring those up when the show with the 3 you must see. So let's go ahead and jump into the daily market recap. And I want to start first just by pulling up these 10 charts. The first 5 index charts, the bottom 5 sector charts. This is the way I like to do it. Just, again, a really quick little review of what happened yesterday. So you can see the Dow almost up to that all-time high. One thing that was nice about the Dow is it did reset the PPO at the center line on this pullback to the 50-day moving average. We didn't quite get there on the S&P, and we really didn't get that close on the NASDAQ. But since then, we have seen a nice rally the last 3 days. This week has been very strong. I don't know that anybody saw this coming. I'm pretty bullish. And after Friday last week, I thought for sure we were just going to be in consolidation mode, maybe even see a bit more selling. And yet this secular bull market just put its head down and is charging ahead. The S&P, there's your breakout, 3 days removed from Friday selling. Here we are back at an all-time high close. The NASDAQ really didn't even take the hit last Friday that the other indices did, but you can see the rebound here, all-time highs. Mid caps and small caps have had a pretty good week. Coming off of moves below the 20-day moving average. If you were thinking that, hey, they're starting to trend lower, I think the move yesterday and today would probably put an end to those thoughts as we move back above those key moving averages. In terms of sectors, one of the groups, and I wrote about this the other day, I really think energy could be a short-term trade. I'm not interested longer term, but I think that if the dollar were to pull back, and that's kind of the one wild card and variable. But if we did get a weakening dollar, I think energy's been so oversold that I wouldn't be surprised if we got a bounce, not only in energy shares, but in the price of crude oil. We did get a pop yesterday in crude oil, and you can see energy was leading the market yesterday. Financials also moving higher. Really, the big boost here came from the 10-year Treasury yield, which has been rising the last couple of days and is trying to move higher again today. You can see the XLF yesterday did break out and close at a new all-time high. Healthcare, nice rebound yesterday, up nearly 2%. And then materials and industrials basically wrap up the strength. All 5 of these groups, as you can see, the worst was up 1.67% industrial. So a lot of strength in the market yesterday, leading this push to the upside. And it was nice to see energy finally participate as well. The 10-year Treasury yield, want to mention just a couple of economic reports. Yesterday, a big one came out, ADP employment report, 291,000 versus 154,000 expected. That was almost a doubling on the jobs. Now, a lot of times you'll see the ADP report say one thing on Wednesday and the non-farm payrolls is completely different on Friday. But non-farm payrolls tomorrow, the market is expecting 158,000, which doesn't seem to be that many considering what we just saw in the ADP employment report. But again, sometimes we see this flip. But tomorrow, in my opinion, tomorrow is the bigger number. We're going to see where things stand. And oh, by the way, tomorrow I'd be looking at that average hourly earnings number as well, because I'm not seeing a whole lot in terms of inflation. And this would be a little bit of wage inflation component for the Fed to take a look at. Last month, it was 0.1% rise in average hourly earnings. This month, it's projected to be 0.3%. So that would be a good thing, I guess, from an inflationary standpoint, if we actually did rise 0.3%. Job market is tightening. You would think hourly earnings would begin to go up. But anyway, that'll be a number I'll be watching tomorrow as well. This morning, we got initial jobless claims out, 202,000 versus 215 expected. So a better number than expected there, threatening to go back below that 200,000 level. Q4 productivity came in 1.4%. Market was anticipating 1.5%. Looking at the 10-year Treasury yield here, this is the rebound that we're seeing. So the market and what we talked about is when we get that big drop in the 10-year Treasury yield, money's going into Treasuries, and the stock market tends to stumble a little bit. Not sell off big, but tends to stumble. And then once we get money rotating back out of Treasuries, sending the yield higher, it seems like that money, all of it, just pours into the equity market. So that big move this week in the 10-year Treasury, moving from about 1.52% up to where it is now, 1.66. Get an update. Yeah, 1.66%. That's a 14 basis point move, and that has coincided with this huge move higher in the S&P this week. So we're seeing rotation from Treasuries to equities, and that is just one more piece of the bullish puzzle. All right, let's go into talking technically. And I want to show you, I talked earlier about a secular bull market. And if you haven't seen this chart, I want to make sure that you see it, because I think what we're in is a generational bull market. Just my opinion, you can agree, disagree, whatever. But I do think that we go through periods, we go through periods of regulation, deregulation. We go through periods of various asset classes kind of being in charge. But I do think that this is very cyclical, and it's long-term cyclical. So when you look all the way back to the 30s and 40s, you can see the secular bear market. It's where you set a high, and then for a long period of time, you don't go above that high. You literally just go nowhere for a long time. Now, this was almost 2 decades. We finally broke out, and I'm going to call this double top, kind of the breakout in the early 50s. And from the early 50s to the late 60s, almost 2 decades, move up, very nice secular bull market. There were cyclical bear markets in the middle, but the overall trend was higher, and we stayed in the secular bull market for almost 2 decades with average annual returns above 11%. Late 60s throughout the 70s into early 80s, you can see once again this sideways action where we just seem to go nowhere. And so this was for a 13-year period where the average return on the S&P was only 2.8%. Not very good, especially when you consider what inflation was doing back then. Then we get into a secular bull market, early 80s all the way through the 90s. Again, almost 2 decades. Average return 15.41%. And then we go into our secular bear market, which all of us remember pretty well. Two big drops, 2 big bear markets, 2000 to 2003 or 2002, and then 2007 to 2009. And it wasn't until 2013 before we finally broke out of this range and started moving higher. So I believe that this is a generational type move to the upside. I think that we will probably have another cyclical bear market or 2 over the next 10 years, maybe 3. But I believe the market's going a lot higher. And this is part of the reason why. I think that, you go through the GDP's expanding for 13 years, a lot more than the stock market went up. It was just fear that gripped the market. Now we're getting into a period where, fear is like 1 week, and then we're right back into the secular bull, kind of like we're doing this week. So I think we're going a lot higher. So that's the backdrop of the way I approach the market. Until this tells me something different, I'm going to be thinking, I'm going to be giving the bull market the benefit of the doubt almost every single time. Another chart I want to show you, since we've got non-farm payrolls coming up tomorrow, is when you look back at this chart, S&P 500 100-year monthly chart on top, jobs 12-month rate of change on the bottom. When this rate of change, when the jobs over 12-month period, their rate of change goes negative, we have essentially a cyclical bear market of some sort. So, I mean, it's telling us a recession, basically. So when you have the jobs go below zero, 12-month rate of change, you are almost always going to have a recession. The one exception was back here. We had a recession in 68, 67, 68, but you can see rate of change never went negative. That's the only one going back to 1950 where it was like that. So right now I'm looking at jobs, the rate of change still being above zero. I mean, you might look at it and say, well, yeah, but it's drifting lower. Well, it's drifting lower, but we've got very low inflation. We've got a Fed sitting on the sidelines. We've got moderate growth, GDP. And so I don't think jobs needs to be way up here. I just think it needs to be positive. And it has been positive. ADP report on Wednesday, yesterday was very strong. We'll see how it goes tomorrow. But I wouldn't become nervous about a recession until we really started to see a big drop in this 12-month rate of change. And I just don't see it. All right, let's move on to earnings, the earnings spotlight. Wanted to pull up a couple of these now. This is Becton Dickinson. Stock is down 9% in pre-market. They beat on their bottom line, 265 versus 263. Chart looks pretty good. It's in the medical supplies area, which had been starting to strengthen. We saw a breakout in January above these prior highs. Relative strength is still not so great, but absolute move, you know, we moved up, pulled back, held the prior lows, and now turning back up again. And BDX has been an okay stock within the group. Not a great stock, but it's been a pretty good stock. It's been outperforming the S&P 500 now for the last 2.5 months. I wouldn't have said that I was overly bullish, but I certainly would have been overly bearish. And yet, stock down 9%, which is going to open it probably somewhere down around the 260 area. I wouldn't be surprised to see a hollow candle print on this, a gap down and then maybe recovery, maybe back up to the 50-day. We'll see. But this was one that was getting hit particularly hard that reported this morning. Another one that reported this morning getting hit, Taco Bell's parent, Yum Brands. Stock, you know, had gapped down back in October with earnings, rallied back a little bit, but on a relative basis, not one of the best performers in the restaurant group. In fact, just a few weeks ago, we were at a 52-week low relative to restaurants. So this one wasn't really suggesting to me that it had a whole lot of, I wouldn't have been expecting much out of the stock. It reported $1 a share. Market was looking for $1.11. So it came up short, and the stock is down another 6.3% in pre-market. Last night, a couple of negative reports came out, or at least a couple of negative reactions. And I would say this is actually one of the bigger surprises that I've seen this earnings season so far. CDAY, Ceridian HCM Holding. Look at this chart. I mean, this has been a straight up move for the last 3 or 4 months. That normally is indicative of a really nice report that is going to come out. It's in the software space, which has been one of the best areas of the market. You can see on a relative basis, software has been on fire. CDAY, relative to software, has been on fire. So it's almost as if this should have been one of the best reports out this quarter. They missed their earnings. I'm really surprised, and I don't think Wall Street's going to forgive them anytime soon. 8 cents versus 11 cents. Stock is down 12% in pre-market. These are the kinds of companies that when they gap down, I'm not sure we're going to get a whole lot of bounce back. We'll see. But usually when you know, kind of lead Wall Street on, like, and that's what this tells me when it's going straight up, that Wall Street was expecting a big number and management came out and laid an egg, I would be really careful. I don't like that reversing candle from yesterday, but still, this overall trend, I would have thought we were going to have a good report. Even if we pulled back, I would have expected a good number, and we didn't get it. So not good there. Peloton, this is the second public or second quarterly earnings report out since the company went public here back in September. And they did beat expectations. They came in with a loss of 20 cents. The market was expecting a loss of 32 cents, but the stock is down 7.33% this morning. So not very good action. Couple bucks, probably looking down here below 31, might be below the 50-day. Really needs to hold this trend line, which it might. Again, when you get a gap down, you got market makers on the other side. Everybody selling, market makers get in on the long side. So sometimes you will see that recovery, especially early. So we'll see what happens with PTON. But the numbers, bottom line numbers actually weren't that bad. All right, let's see. Let's take a look at a couple of these that came out with really good reactions. Here was one that actually missed earnings expectations, but it's up 8% this morning. Twitter, 25 cents versus 28, but their user number came in much higher than expected, and that is giving the stock a lift. I don't know about this one. I mean, it's been down. It's going to get a pop on a relative basis today, but this has not been a very good one. It missed on its bottom line. I wouldn't trust this gap up. I think until this stock can begin to show relative strength and get back through a major gap resistance level, which is up here at 38, almost 39 bucks, I would probably be a little concerned and nervous about the company. So it is up 8%. So that is probably what, about 270. So somewhere around 36 bucks probably is going to open. Again, I think it's got a lot more work to do. I don't know that I trust Twitter just yet. Let's see what else. How about Estee Lauder? Estee Lauder, nice report out. Easy beat on the bottom line, 211 versus 191. Stock is up more than 5% in pre-market. And this is one that was at a 52-week high relative to personal products at its high. And then it went through this period of consolidation, selling, whatever you want to say. Nice little pullback, probably a little bit more than I would have wanted, to be honest. But that relative strength came through with the earnings report today. 211 versus 191, up 5%. I would expect to see Estee Lauder head back and test that 220 area. Let's see, maybe just a couple more here. I tell you what, PAYC, this one came out last night, was not it's not a great reaction. It was a pretty good report. At least in terms of earnings. I didn't see guidance on a lot of these stocks. So some of these may have lowered guidance or just, suggested maybe things would be a little softer. But PAYC reported in the last quarter 86 cents versus 77 cents. It did print a pretty ugly bearish engulfing candle yesterday, and it is down in pre-market 4.5%. But that would be about maybe 12 bucks, maybe 14 bucks, something like that. So I would suspect that after a gap down, we're going to see a rally on this one. This is in the software space, and you can see the stock just set a new 52-week relative high to software. They beat on the bottom line. I think probably this pullback is going to be buyable here. Let's see. How about SPGI? This is SP Global, and nice move here, breaking out recently. Relative strength has been moving lower and actually was down at about a 6-month relative low coming into its earnings report, but its earnings were pretty good. 253 versus 241, stocks up 3.5% in pre-market. What I would worry about is on the gap up, see maybe if it pulls back and prints a bearish engulfing candle that kind of engulfs all of these candles. And I say that because I saw almost the exact same thing yesterday with Chipotle. Chipotle, see the move up, sideways consolidation. We gapped up, good strong report, and then it comes down and basically engulfs the last 2 weeks of candles on pretty big volume. So I'd be maybe looking at that, especially because of this relative weakness here. This could be a last hurrah kind of a thing. So unless you gap up and keep going, and we see that relative strength turn up, this is a stock I might be a little bit more nervous about with its earnings coming out and how it reacts. One last one, and we'll move on to upgrades and downgrades. How about REGN? This is in the biotech space. We saw Biogen explode yesterday. Some pretty nice moves in biotech lately. Amgen had a really nice day yesterday. Well, Regeneron Pharmaceuticals came out, blew away bottom line, $7.50 per share versus $6.90. Stock is up 4% pre-market. It went all the way. It had a really rough 2-week period to end January. And to be honest, when it lost upper 350s, this low over here, I was not a big fan. But the stock did go down, hold the gap support area down here, and it has now been rallying, and it's looking to open close to this high, probably just a little bit under it. So anyway, REGN definitely picking things up again, but I would like to see another relative breakout on the stock. We'll see if we get that today. All right, let's move on. Going to go to upgrades and downgrades. Got a few of them here for you. First, we've got Cummins being upgraded today. So CMI with the upgrade, what's it look like on the charts? I'm not impressed. This is a stock relative to its peer group that's been drifting lower. Its peer group versus the S&P was just down near a 52-week low. So you got a weak stock in a weak group. I'm not buying into this upgrade. I think you get an upgrade, you get a test of the 20-day. I would be surprised if it didn't go back down one more time at least. So not a fan of this upgrade. GD, I can tell you this has not been one of the best defense stocks. Defense been moving up, breaking out. GD has not been doing that. And as a result, check out the relative strength. I would, whoever upgraded General Dynamics, I probably would have saved it for one of the other defense stocks, probably something like AAXN, the small cap, which has been on fire. This one is actually in our aggressive portfolio at earnings beats. Has been a great performer in the defense space, and to me, this is a stock that looks much better in terms of relative strength than General Dynamics. So just not a fan of this upgrade either. Micron in the semiconductor space. Micron's been doing much better. And after it went through a couple of months back toward the end of last year, October and November, so going sideways while the group was breaking out, you can see it took a relative toll, but it has come back and it is now performing much better, getting close to a new 52-week high in terms of relative strength. And check out the volume that's come in on these moves. So we held support, the 50-day, turning higher in a good group. I would agree with that upgrade. I like MU. Downgrades, Forum, and I think, I don't know if they just reported or if they're going to report today. I can't remember. So I might have it up here. Let's see, Forum. They did report yesterday after the close. I did not see their earnings report, but the stock's being downgraded, so maybe it was based on the earnings. Looking at the chart, though, this has been one of the better stocks in the semi space. So if they beat and the stock is being downgraded and gaps down, that actually could be a nice opportunity. I would suspect the breakout around 23.5 would provide great support. You got gap from about 23.75 to 24.5. You got gap support there. So any weakness actually down that level, if they beat, that's a big question for me. But if they beat, that would be an area I might consider the stock. Let's do one more downgrade. Let's go with PRSP. This is Perspecta. This is another software stock. The stock gapped up and is now put in a cup. Nice uptrend. I think I see a cup here. Good volume trends. Only thing is it's not been a great performer versus the software space. So what I would look for if I was looking, thinking about the stock is maybe a pullback to the 20-day. Maybe this downgrade gets you that. And then I think we get a breakout. I would be looking for a breakout. Now, whether or not we see relative strength, I don't know. But I would be looking for a breakout after maybe a 20-day test. All right, let's keep moving. We're going to go to scooter movers before we get into the 3 you must see. And also I wanted to do here on scooter movers is just first point out that make sure under the gear shift thingy up here that you have your chart list panels, your scans and alerts, additional data panels and so forth, and commentary if you want, all checked, especially the additional data panels. That's where I have my scooter report. So if you have that checked, this is what you'll see. I set it up so it's large cap, mid cap, small cap, and then, I don't know, sometimes I have top up, top down, whatever. But what I wanted to do is just take the top up and just click on RRG, and it'll instantly put those 10 stocks on an RRG. Now, you got small cap, so I always change the benchmark here to the small cap, and then update, and then maximize it. And when you maximize it, tail length right there, okay. And then you can kind of see what each of these stocks have been doing. And you can see SCOR was a terrible performer, going way over there on the left side. And if you go down here at the bottom, you can actually click on that SCOR and it highlights it. That's another pretty cool feature. And so now when you drag it, that's the one that you see primarily. But it's beginning maybe to lose a little bit of strength. Looking at some of these other ones, trying to see what looks good here to me. I think this CDR, I'm going to click on CDR. Watch what this one's doing. So it's in the leading, moves into the leading, goes down into weakening, looks like it's going to go in the lagging, and now it's starting to roll back up again. So that's one that I might take a look at. So let's just pull up, actually, I think you can go down here. But CDR, if I click on the chart, then I can pull my chart up. Okay, so now I look at it, it's okay. It's not great. It's an income fund. It's not something I really want to invest in this kind of market. But that's the process that I would go through, is to take a look at those RRGs and just get a sense. The ones that go into the strengthening and then fall back into weakening and then turn back up, a lot of times that weakening is just a consolidation period. And then you turn right back up and head into the strengthening again. So a lot of your strongest stocks in the market will do that if you pull them up on an RRG. All right, let's wrap up the show with the 3 you must see. And I am going to start with, we were just talking about small caps. I'm going to pull up the IWM versus the SPY. And I'm going to do a daily chart. I'm going to go back a couple of years. And I just want you to see how badly small caps have been performing. Now, I mentioned at the top of the show that this week's been a pretty good week so far for small caps. And you can see we're starting to get a push back to the upside. Now, you might look at this and say, well, it's been in a downtrend relative to the benchmark for almost 2 years, a solid 20 months. Why would I want to get in? Well, if you look at the history, and I'm going to bring up a weekly, and let's go back 20 years. I mean, it's, that's basically the entire century so far. This is the longest period of underperformance of small caps throughout the last 20 years. This is the second longest. This is probably the longest. Looks like full 2 years or almost 2 years. This would be the second longest. I am really looking for small caps at some point to pick back up again. I don't know if that's it this week. I don't know if we just made our final low, but we are putting in relative lows with relative higher PPOs. So we do have a positive divergence. We'll see whether or not that matters, but just something to at least be considering. Next up is crude oil. I mentioned energy top of the show. Just wanted to show you a chart on crude oil. Crude oil getting all the way back down here just below these bottoms. And then yesterday put in a bullish engulfing candle. Nice rally in crude oil. I think this could mark a bottom off of a pretty significant downtrend. Just wanted to point that out for you. That's one reason why I do like the XLE short term. And I'm not surprised we had that big move yesterday on energy. The last stock I wanted to show you is Square. And this is why it's so important to look at resistance. I mean, if you look at this, and I'm going to take this out maybe 2 years, but we've had multiple tops now right here at about 82, 83. Now, I think eventually Square's going higher, but this is the importance being a short-term trader and following the resistance. Yesterday's gap up was, we got up over $82, very close to all of these tops. And then we printed a bearish engulfing candle. I think this looks good, but we could see a 20-day test before we rally back. So those are my 3 that you must see. Really appreciate everybody joining me. Hope everybody has a great day today, and we'll be back next week with Trading Places Live. Happy trading.